Okay. Dear students, this is your trainer, FR trainer, Mustafa Mirchawala from Mirchawala's Hub of Accountancy. And today is the revision day class of F7 FR, right? First of all, the objective of this class is not to solve any question, although I'll solve the question, but this is just solving the question is not the objective, because I have conducted many revision days and they are already on YouTube as well. And our lectures are already very, very detailed. Almost all latest past papers are covered. But the objective of this class is confidence, okay? Because in last days, students normally, their confidence got shaken and they think negative sometimes. So the objective of this class is to align you that you can easily clear it. Like, let me share you the very latest results. Although I have not taken data for all students, but those who sent me the data, these results you can see. The latest attempt, when these students can score, you can also. They also studied in the same way that you are doing. They did the course, they read the book, study text for IS, IFRS. They solve the ratio analysis question and they sent me the questions for reviewing. You know, I give marking facility as well for ratio analysis question. So this is what they did. They read the examiner report, always recommended examiner report, because in the examiner report, examiner guides you about the mistakes of students so that you don't repeat those mistakes which the previous one did. Okay, right? So it's not difficult. Now, the past paper we are going to do is very latest past paper, and that past paper release, I think 15 days or 10 days before on the accglobal.com. It's available on accglobal.com. And as we all know, for skills module, applied skills module, they only disclose last 40 marks. ACCA discloses only last 40 marks past paper, That's why we are going to discuss the last 40 marks. In my previous one of my videos, I said this, that I attended one global conference recently, and they told us that the reason of failure in applied skills paper globally, all over the world, is last 40 marks, not first 60 marks. The major reason is last 40 marks. Normally, students don't practice last 40 marks properly, or they don't have grip on last 40 marks properly, or they don't solve the mock exams. That's why they are not in habit of solving the complete paper on time. So we always recommend you to solve the mock exam. Even we conduct the mock exam. So if you follow this route, you can also score very good. Okay. So now be confident and let's solve the questions. We have two questions in the latest past paper. One is final account, and the other one is ratio analysis question. Okay. Obviously, ratio analysis is the hot favorite topic of examiner, and it always comes. So you must know. But you will see they are the very latest past paper, the last attempt past paper, and you will see they have given you normal things. You can a normal person can easily do it. Okay. Now, how will we approach the class? First of all, I'll show you the past paper on my screen. If you want to take the pic, you may, and I'll just discuss things with you, and then I'll shift it to my Excel file. First of all, I'll teach you through pen, and I'll teach you in a normal way with discussion way, and then we'll go to the formal Excel file and we'll solve it. Okay, let's start. Let's don't waste the time. Okay, so this is your question. You have. Okay, one more thing I forgot. We have made a WhatsApp group for you guys. It's our routine. We make in revision days, we make the WhatsApp group. So our admin has just shared the WhatsApp group link in the chat box. Kindly please join that WhatsApp group so that you guys can easily interact with each other. You guys can share your queries. Even I'll also share some stuff with you, all other videos as well, relevant data. So it's very relevant for you. Okay, so it's better you join the WhatsApp group. Thank you. Now, you have seen there is a trial balance in front of you. And luckily the trial balance is balanced. There is no suspense account thing in that, right? Okay. Now, first of all, we all know that the most important thing in any financial reporting question is the accounting period. So what's your accounting period? Your accounting period is ending on 30th June X2. Don't sleep now. Next 2 hours, 2.5 hours, you can't sleep, please. Your accounting period is ending on 30th June X2. Accounting period ending on 30th June X2. That means 1st July X1 is the beginning of the accounting period. Your accounting period is 1st July X1 to 30th June X2. Okay, this is your accounting period. Now, adjustment number 1. Very simple adjustment. It's basically they have done one error in this. On 1st January X2, see, 1st January X2, mid of the year. Your accounting period is 1st July X1 to 30th June X2. That simply means 1st January is the mid of the year. Print company raised funds. See, they generated some finance, $30 million. Okay, this finance may be equity set. This may be share issue or loan. Let's see what is this. The full amount was recorded in the nominal ledger as a bank loan. See, they have recorded complete amount as a loan. You can see in the trial balance. In the trial balance, see, they have booked complete 30,000 as a loan. But in reality, what's the truth? See, the funds actually consisted of a bank loan of 16 million and 14 million from the issue of 7 million ordinary shares. See, there is out of this 30 million, 16 million is the bank loan. 16 million is the bank loan. And yes, 14 million is the share issue. And 14 million is the share issue. But how many shares? 7 million shares. 7 million shares. So you issued 7 million shares. Sorry, we issued 7 million shares for $14 million. We issued $7 million one ordinary shares for $14 million. That means there is a share premium as well. There is a share premium as well. There is some share premium as well, because ordinary share capital is always recorded at face value, par value. Ordinary share capital is always recorded at face value or par value. Okay, right? So 14 million we generated 14 million, and we issued only 7 million shares. So there is some share premium as well. But you can see they have done error. They have recorded complete 30 million as a loan, but in reality, only 16 million is the loan. Remaining 14 million is the equity. Okay, so this is the first mistake. So let me correct you the mistake. If you are active, simple entry. See, correcting entry. We'll debit the loan by 14 million. 14 million here means 14,000. 14 million here means 14,000. We'll credit the ordinary share capital with 7,000. Why 7,000? Because we issued 7 million shares. It means 7,000 shares and the face value is 1. We issued 7,000 shares, or you can say 7 million shares with face value of $1, and the remaining amount will go to share premium. So this is going to be the correct entry. This is going to be the correcting entry. This is going to be the correcting entry. Students, this is going to be the correcting entry. Okay, and you have to correct this loan as well. Definitely you have to correct this loan as well. So this is the first mistake they did, and we just corrected it. Very easy. It's like F3 level, basic level thing. Now, the second error, which is more interesting. Second error, what is the second error? When they booked complete transaction as a loan, look at here. When they booked complete transaction as a loan, that's why they calculated interest on the complete amount. They calculated interest on the complete amount. Read it. An accrual for 6 months. An accrual for 6 months interest has been included in the trade and other payables and recognized as a finance cost. Okay, that's the mistake. However, the calculation of interest was incorrectly based on the nominal ledger loan balance. See, in the above trial balance, you can see the loan is 30,000. So they have calculated interest. They have calculated interest. They have calculated interest. They have calculated interest according to the new amount. They have calculated interest according to the new amount, the wrong amount. So we need to correct it. Okay. So not a big deal. Let's do it. Simple. Wrong interest. They booked 30,000 times 5%, and obviously mid of the year, the loan is generated in the mid of the year, times 6 upon 12. That's what they booked. 30,000 times 5% times 6 upon 12. Quick, students, please help me. Tell me. 30,000 times 5% times 6 upon 12. Okay, they booked 750. But you know what is the correct amount? The correct amount should have been, the correct amount is 16,000 times 5% times 6 upon 12. This is the correct amount. How much? 400 is the correct amount, but they booked 750. They booked 750, but 400 is the correct amount. So definitely we need to make a reversal entry for 350. We need to make a reversal entry, and strictly open your ears. There is no requirement of making entries in the final account. Even in the examiner solution, they don't make entries. If you don't have time, don't waste time on entry. Although sometime I make entry, but it is not mandatory. Okay. So you know, what is the reversal? What should be the reversal entry? What should be the reversal entry? See, they are saying that we have booked trade and other payables. Accrued is booked in trade and other payable. So entry will be, correcting entry will be, now you will credit the interest expense by 350, and you will debit your liability, trade payable or other payable, by 350. You will debit your liability by 350. Okay. So these are the two entries we need to make. These two entries we need to make. That's it. These two entries we need to make. Not a tough job, not a big job, ordinary thing, ordinary thing. Okay. Even I can show you. See here, see this. Here they have booked 750. Here they have booked how much? 750. So we need to reduce 350 here. Okay. We need to reverse the interest expense by 350. Okay. So that we get the correct amount. And obviously when I'll be making the income statement, I'll write the correct amount. Okay. Right. My dear students, did you understand this adjustment number 1? Did you understand the adjustment number 1? Please write on the chat box. It's not challenging. It was not difficult. Now you are on the last month. You should be very active. You should be very fast. Write in the comment box, please. Write in the comment box. So we just did two things. See, they have, let me increase the size of this. So see, they did two mistakes. Number 1, they booked equity as a loan, 14 million equity shares as a loan. So we corrected it. And number 2, when they booked extra loan, that's why when they booked extra loan, that's why they book extra interest expense as well. So we need to reverse that interest expense. Simple. We just did two things. That's it. Yes, there was a shortcut. Shortcut was also available for interest entry. For interest entry, there is a shortcut. One guy is saying, yes, that's also possible. You can do it. You can directly calculate the correction of interest through 14 million. Yes. One guy is saying it's okay. It's okay. No issue. No issue. Now the next adjustment is honestly F3 level adjustment. Next adjustment is honestly F3 level adjustment. F3 level adjustment. To be very honest, IS2 inventory. You guys better know inventory should be recorded at lower of cost or NRV. Inventory should be recorded at lower of cost or NRV. Remember? Now let's attack. Let's attack. Read it. Inventories at 30th June X2. 30th June X2 is your year end. 30th June X2 is your year end. 30th June X2 is your year end. Okay. So that means they are talking about closing stock. They are talking about closing stock. And the value of total closing stock is 5,700. 5.7 million means 5,700. Okay. This includes, see, $1 million line. This is very includes. That means in this 5.7 million, these units are included. 700 units with a cost of 1,400 per unit. In order to sell these items, they need an additional extra cost. See, additional cost to sell or cost to make, cost to sell or cost to make. Hope you remember the definition of NRV, net realizable value. At which point then they can be sold for $1,600. Then they can be sold for $1,600. I'll teach you like F3 style, the way I teach this adjustment in F3, because this is F3 level adjustment. I'll teach you in F3 way. Okay. If you guys want to take the picture, of this, you can, so that you'll have on the mobile as well. It would be easier. Now listen, see this. Your closing CS means closing stock already is 5,700. Okay. Already closing stock is 5,700. Look at me. You entered in the storeroom. You found all the stock, storeroom full of stock, and the total valuation is 5,700. Okay. Now, when you looked at the whole stock, you found 700 units, special units. Inside the room, there were 700 special units. So there was some problem with those units. So you decided to check those units. So first step, take out those units from the room. 700 times, what is the cost? Cost is 1,400. Okay. 700. Let me do it like this way. Less 700 times 1,400. Obviously, we'll write without 3 zeros. This is 980. This is 980. Okay. Take out from the room. 5,700 minus 980. Take out those units from the room. How much is this? 5,700 minus 980, please. 5,700 minus 980, 4,720. Thank you. Now we have taken those units. Now let's go in the lab. Now we are going in the lab. This is our lab. See, in the lab, we'll apply IS2. This is cost. This is NRV. Wait, how much is the cost? Cost is 980. NRV is selling price less cost to sell or cost to complete. Okay. NRV is selling price less cost to sell or cost to complete. So the final selling price we'll get is 1,600. Final selling price we'll get is per unit is 1,600, less the additional cost we have to incur is 400. So it's 1,200. Okay. Multiply by how many units? 700 units. Can anybody tell me what is the amount? 1,200 into 700 is how much? 1,200 times 700. Tell me answer without 3 zeros. Yes, it's 840. It's 840. Now, tell me. You tell me. We have just taken out those units from the room. Look at me. We have just taken out those units from the room and we took them in the lab. This is our laboratory. And in the laboratory, we are applying IS2. Now, here is the cost. The cost of these units is 980. The cost of this unit is 980. And the NRV is 840. NRV is 840. Now, again, put these units in the room because they are still closing stock. These units are still unsold. These units are still closing stock. So come on, throw it inside the room. But before entering in the room, apply IS2 properly. And IS2 says inventory should be recorded at lower of cost or NRV. What is the lower amount? Lower amount is this now. So you will add 840 here. So what's the correct closing stock, my dear students? It's 5560. This is 5560. Now this correct closing stock will go in the cost of sales. This correct closing stock will go in the cost of sales and also at the year-end balance sheet, SOFP, because closing stock goes two ways. two way. Closing stock is posted on two statements. Number one, income statement in the cost of sales, and number two, SOFP, because closing stock is your year-end asset. Closing stock is your year-end asset. Okay. Now, the way I taught you right now, it's like spoon feeding. I taught you in the F3 style, but there is a shortcut as well you can do. Listen, what was the original amount of stock? 5,700. Original amount of stock was 5,700. And by how much the value went down? See these two. By how much the value went down? By how much the value went down from 980 to 480? From 980 to 480, by how much value went down? From 980, it's 140. You can directly deduct 140. So you will get 5560. This is also shortcut, totally acceptable. This shortcut is acceptable, and I'll do in the Excel, I'll do with the shortcut. Okay. If you want to do this way, this is also okay. If you want to do with the shortcut, the amount written off, we call it amount written off simply. Students, did you understand this adjustment? Did you understand this adjustment? Please tell me. It's F3 level. We have also sent you the past paper on WhatsApp. Okay, on the WhatsApp group, I have also sent you the past paper. Those who want to use from there, they can. Okay, now let's move to adjustment number 3. This is adjustment number 3. Wait, do you remember IS 37? IS 37, and in IS 37, your teacher taught you this onerous contract. Onerous contract. What is onerous contract? Onerous contract is a contract which is signed, which has already been signed, and now you came to know that the future economic benefit is less than the unavoidable cost. Unavoidable cost is higher and the future economic benefit is less. So now you have to book this loss. You have to book this loss. You have to create provision for this loss. Why? Because the contract has been signed. You can't take U-turn. The contract has been signed and you can't take U-turn, right? So you have to book provision for onerous contract. Hope you remember the workings of onerous contract. In the onerous contract, you used to book provision for lower off. You used to book provision for lower off. The first option was present value of future rentals of future losses. And the second option is the penalty. The second option is the penalty, whichever option is lower, you go for that. In real life, we also go for less loss. In the real life, if we have two penalties, we have to pay one penalty out of two. We always go for the lower one. So here the same concept is here. Hope you remember the onerous, ONEROUS, onerous contract. Okay, but this adjustment is again easy. This adjustment is again easy if you are not sleeping. If you are not sleeping, it's easy. Come on, look at it. At 30th June X2, almost year end, print company has a contract to purchase 22,500 units. These are units. Electrical components over the next 3 years at a cost of 450 each. See, we have made the contract. Now we have to buy it at any cost. The purchases are made at a constant rate. These components are no longer required for their initial purpose. See, but do have an alternate use. Now just think. First of all, my dear student, we signed the agreement. We were expecting that we'll use these units, but suddenly things got changed. You know, there is a war going on in the world at different parts. There is a climate change, a lot of factors. So now we came to know that we can't use for the initial purpose. So let's use it for alternate purpose now, but there is a cost, which will require additional manufacturing cost of 600 per component, 600 per component C. So now there is the costing has been changed. 450 original plus 600, 450 plus 600, 1050. Use your calculator. Now your per unit cost went to 1050. Okay. Thereafter, each component can then be sold for 900. Look at here. That means you have to incur cost of 1050. You have to incur cost of 1050, but the selling price is only 900. Selling price is only 900. That means you have to intentionally, you are bound now. You have to incur 150 per unit loss. You have to incur 150 per unit loss. Okay. Now, what is the alternate option? What is the alternate option? Active students, please look at the screen. Alternatively, print company can cancel the contract immediately by paying a penalty of 4 million. See, this is the second option. This is the second option. Now, not difficult. Within seconds, you can do it. You will have to go for lower off. 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 Okay. Now, wait. Any adjustment resulting from this information should be made to admin expenses thanks to examiner. See, examiner is guiding you properly everything. It should go to admin expenses. Okay. Now, listen. Not difficult at all. Not difficult at all. Look at here. Original cost is, I think, 450. New cost is 600. So now the per unit cost is 1050. 1050. Look at here. But your selling price is only 900. So you are expecting a loss per unit of 150. You are expecting a loss per unit of 150. And my dear students, you have to buy 22,500 units. So can anybody tell me the total loss by removing 3 zeros? The total loss should be around 33. Yes. Loss working 1. Using working 1, the loss is 3375. So the first option is 3375. 3375. Okay. Now, the second option is penalty. The second option is penalty, which is 4,004,000. Now, you tell me, students, you tell me, you should pay 4 billion or you should say pay only 3375. Which loss is better? Lower. Yes, this loss is good. This loss is better. So definitely we'll go for 3375. We'll go for 3375. We'll go for 3375. Okay. Now, one new thing. This 3375 we have to bear in next 3 years. This 3375, open your eyes. This is a separate thing. Now these things takes you towards position. This 3375 is the next 3 years loss. So if you divide 3375 divided by 3, so it's, I think, 1125 per year. So that means in the very next year, within 1 year, you have to bear 1 year loss. Within 1 year, you have to bear one year loss, 1125, and the remaining loss you have to bear after 1 year. So hope you remember IFRS 16. Hope you remember IS 20. We used to study. We have to break the liability between current and non-current. We used to study. We have to break the liability between current and non-current. We have to break the liability between current and non-current. Remember? So you will have a current liability of this loss in the balance sheet. You will book 1125, and you're going to book non-current liability of 1125 times 2 is 2250. That's it. And yes, the shortcut entry, no need to make the entry. P&L debit, provision credit. P&L debit, provision credit. Okay, definitely it's a loss. And P&L debit means you going to hit admin expenses. Profit and loss account debit means you going to hit admin expenses, my dear student. But I would say this adjustment is also not difficult. This is simple adjustment. This was simple. Yes, the current non-current thing, you know, everybody can't go till there. Did you understand the adjustment? Did you understand the adjustment? Please write on the chat box. All of you, please write on the chat box whenever I ask you the feedback. Now you listen one thing. Honestly, this is the super latest past paper. So those students who can't do this, they should be hanged. Those who can't clear this paper, we should make video against those students. Just think. This is easy adjustment, not difficult. Yes, FR level is not easy. I agree. There are some very difficult things in the paper as well, but till now it's normal things. Normal. You have studied even more difficult things in the class. In the exam kit, things are more difficult. You guys don't need to copy anything, please. Okay, I'll go to the Excel and I'll solve it there. Don't worry about it. Now, next thing is IFRS 5. IFRS 5 held for sale. IFRS 5 held for sale. IFRS 5 held for sale. Listen. On 1st of July X1, 1st July X1, this is on the first, wait, hold. All of you recall the accounting period. All of you, come on, quick. All of you quickly recall the accounting period. It's 1st July X1 to 30th June X2. 1st July X1 to 30th June X2. 1st July X1 to 30th June X2. That means, hold. This 1st July X1 means the first day of accounting period. 1st July X1 means first day of accounting period. The directors of print company decided, see, they are sure, decided to sell a piece of machinery, and the asset met the criteria to be classified as held for sale at that date. Okay, that means right from the first day of accounting period, it is held for sale. So, you know, those assets which we classify as held for sale, we don't depreciate them, because we convert them into current assets, and we don't depreciate current assets. Okay, now the machine which costs, see, this is the cost 2.4 million and had a carrying amount of 1.5 million. Important. This is the cost, this is the carrying amount. Carrying amount means NBV. All of you be active. What is the accumulated depreciation? Come on, tell me. 2.4 million is the cost. 1.4 million is the NBV. Cost is 2400. NBV or carrying value is 1500. So what is the accumulated depreciation? 900. Again, this is easy thing. You guys are no more kids, no more infants. If you can't pick these things, it's your fault. Sorry. So this is the data. NBV is 1500. Now you remember, whenever we go to IFRS 5 held for sale, so now there is, listen to me. Now there is no intention of usage. There is no intention of usage. We have to sell it. That's it. One shot sell. Now we have to sell it. So the asset is going to give us benefit with sale. The asset is going to give us benefit with sale, not usage. Okay. Simply asset will benefit us with sale, and sale means fair value less cost to sell. Now we'll get the only one benefit, fair value less cost to sell. Okay. We'll get the only benefit, that is fair value less cost to sell. Now don't sleep. They will give you a little dodge. So at that date, here means 1st July X1. 1st July X1, the fair value less cost to sell was 1.14 million. See, initially, the fair value minus cost to sell is 1140. So do you remember the impairment concept? Right now the NBV was 1500. Right now the NBV carrying value was 1500, but we are going to get benefit of 1140 only. So we have to book an initial impairment of 360. We have to book an initial impairment of 360. initial impairment of 360 we have to book. Okay, now going forward, very interesting. The machine was sold for 1.1 million after selling cost at 1st July X2. Now please don't sleep. Just one day after the year end, your year end is 30th June X2. Your year end is 30th June X2 and you sold it after one day. That means at the year end it is not sold. At the year end again it is not sold, so it will go as held for sale. In the SOFP it will go in the current asset section as held for sale. But can you tell me at what price they sold it? They sold it for 1.1 million. That means on the very last day, the fair value less CTS was 1100. On the very last day of the accounting period, the fair value less cost to sell was 1100. So there is a further impairment of 40. There is a further impairment of 40 is needed. There is a further impairment of 40 is needed before the year end, because just think, just after the one day of accounting period, we sold it for 1100. So that means the fair value was 1100. The fair value was 1100 at year end. So there is a further impairment. So these two are the impairments, students. These two are the impairment, 360 and 40. Now, examiner has written his comments on it. Examiner has said it's okay if you want to show deep working and you write in two pieces that 360 and 40 and then you add it, it's okay. But if somebody books directly 400 impairment, that's perfectly okay. You can directly, because from 1500, see, from 1500 to 1100, the total impairment is 400. Total impairment is 400. Total impairment is 400. You can directly book. And now one more thing which you all know, that we guys normally book these impairment in cost of sales. We guys normally book these impairment in cost of sales. Okay. Now one last thing. Hope you have done this type of question in final account. Read this line, super line. See, this is super line. This is called super line. No adjustments have been made to take account of even classifying the machine as held for sale. What does it mean? It means this machine is still in non-current asset. They have not taken out the cost of this machine. They have not taken out the cost of the machine, the accumulated depreciation from normal plant and machinery. So that means this machine is still part of normal plant and machinery. So first you have to remove these two, this and this. First you have to remove these two from normal plant and machinery balance, and then you have to book depreciation expense for remaining. Obviously the remaining plant are not held for sale. Just think, we have 5 plants. We have 5 to 6 plant, and out of this 5 to 6, only one plant we did held for sale. So remaining are our own plants. So remaining plants are our own plants and they should be depreciated normally. So we need to do it. But again, you will ask one question, sir, how to depreciate? There are two methods, straight line method and reducing balance method. There are two methods, straight line method and reducing balance method. So good news is the next line. The next line is the good news. The next line is the good news. Read. Print policies to depreciate plant and machinery at 15% per annum on cost. That is a straight line. Very simple. You have to apply this 15% on cost to remaining plant, not all plant. Remaining plant, okay? Because the plant which you are going to remove from the normal plant list that is held for sale. So we never depreciate held for sale assets. We never depreciate held for sale asset. We never depreciate held for sale assets. Okay. Just wait 30 seconds. Azan is going on. Wait. Okay, listen, students. Now, see, there is a plant and machinery balance. All of you look at here. This is the plant and machinery cost balance, and this is accumulated depreciation. Okay. So what I will do, nothing to do with the land. Just keep the land aside because land is non-depreciating asset. We all know land is non-depreciating asset. Leave it. Now look at here. So cost is 16,200 for the whole plant and accumulated depreciation. First of all, we'll remove the cost and accumulated depreciation balance of that asset which is held for sale, and we'll simply depreciate the remaining plant. Okay, come on, look at here. This is 16,200. This is 7,290, I think. Now HFS, the cost of HFS asset was 2,409. Okay, 2,400 for this, and 900 is the accumulated depreciation. Okay, so 16,200 minus 900, tell me what is the number? 13800. 13800 is the remaining cost. And what is the accumulated depreciation? 6390. Okay, now finally calculate the depreciation expense for the year. Depreciation expense for the year, because obviously for the year depreciation has not yet been calculated. You tell me which method should I apply? Percentage on cost or percentage on NBV? Percentage on cost or percentage on NBV? It's percentage on cost. So this is your cost. You will write 13,800 times 15%. It's, I think, 2070. Thank you. Okay. Now, what plant you will take to SOFP? Simple. What amount you will take to SOFP about the plant? 13,800 is the cost. And what will be the accumulated depreciation? There is already some accumulated depreciation of 6390 plus some new depreciation of 2070. Tell me, what is the NBV? 5340. 5340 is the NBV for plant. 5340 is the NBV for plant. Or sorry, somebody told it's 5340 or 5240. It's 5340. Okay, 5340. Now listen, the way I solve this, I solved this thing many times in my class. If you are active, remember, in my class I solved this type of thing many times. Now one thing, this is the NBV of pure plant. This is the NBV of pure plant. There is one land as well, but we don't depreciate land, so simply add land in this balance. If you want to write the one figure for property, plant and equipment, and obviously there is one figure for PPE. So this 5340, this 5340 plus the amount of land, this 5340, this 5340 plus I think 45,000 is the land. 45,000 is the land. So the total amount is 50340. That's it. Now one thing, this thing will go, this 2070 will go in the cost of sales. Okay, this 2070 will go in the COS, cost of sales. Cost of sales, you remember, cost of sales for the year depreciation goes in cost of sales, added in cost of sales. For the year depreciation is added in cost of sales. You getting? Did you understand? Please tell me. Now, the good news is the tax adjustment is nothing in this question. It's 1 microsecond, just 1 microsecond. No current tax, no deferred tax, nothing. Just one piece of cake. Look at here. The last, the income tax refund for the year has been estimated to be 2.53. Normally, they tell you the income tax liability. So for income tax liability, you book and you make entry expense debit and liability credit, expense debit and liability credit. Now this time you'll make the reverse entry. Tax refund is your income. So you will make the entry tax receivable debit. Now you're going to receive the tax of 2530 and P&L credit. It's your income. That's it. Sir, there is no under over provision. No, there is no under over provision. No, 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 no. Go and check the trial balance. Nothing. No deferred tax. Nothing, nothing, nothing. Just this thing. So there is only one tax income. There is only one tax income. Income, not expense. Tax income you will book in the income statement. And in the year end, there is a current asset. There is a current asset which we call tax receivable. There is a current asset which we call tax receivable. That's it. So tax adjustment was very, very easy. Tax adjustment was very, very, very easy. Yes. Provided there is no under over provision. Provided there is no under over. Okay. So now I have discussed everything of all adjustment of these questions. Now we have almost invested 50 minutes, please. So now don't stop me when I start typing. Now I'll make the income statement. Okay. And I want some active response from you guys, right? This is the last adjustment. You can see it's simply income, the tax refund. It's not tax expense, it's tax income. Refund, normally we get refund when we are in losses. So tax department gives us relief. Normally we make entry this. See, when there is an expense, we make the entry P&L debit and tax payable credit. Remember the entry of current tax. Normally this is your current liability. You normally book this as a current liability. But this time the transaction is reversed. This time the transaction is totally opposite, right? Okay. So I repeat, you have the question. I have sent you the question on WhatsApp. Keep the question with you. Now quickly I'll move on. I'll move on to my Excel sheet. So be active now, because I have discussed everything now with you guys. Okay. Okay. So in the adjustment number one, you need to make, if you want to make one correcting entry, the correcting entry should be 14,000 with the 14,000 with the bank. Okay. Then bank loan debit, you will credit the share capital by 7,000 and you will credit the share premium by 7,000. Already I have discussed this with you. Okay. Now finance. Now one thing students sometimes ask, see, I have already written something on the screen. This I normally write in order to save my time and your time, because our time is precious. It's not my objective to teach you how to write, how to type. It's not my objective to teach you how to type. You are old enough to do this. Okay. So my objective is to solve the question in front of you. That's why I already use ready-made things. But in the exam, you will have to do everything from the zero. In the examination, you have to do everything from zero. Don't forget this thing. Okay. So now finance cost already included in the trial balance. Was, I think it was 30,000. 30,000 times, wait, 30,000 times 0.05 times 6 divided by 12. See this, 30,000 times 5% times 6 upon 12. This is the already 750 is the already amount they have booked. 750 is the already amount they have booked. Okay. Now, what was the correct finance cost? The correct finance cost was equal to minus how much? It was 16,000 was the correct loan. 16,000 times 0.05 times 6 divided by 12. See this. Okay. So now 750 was the correct amount and 400, sorry, 750 they have already booked and 400 is the correct amount. So let's take the difference. Let's take the difference. Let me check. So this 350 reversal of finance cost. Okay. Now, no need to make any entry for this. No need to make any entry for this. This working is more than enough. More than enough. That's it. That's it. Leave it. Now, one thing. This is your adjustment number 1. What was your adjustment number 2? Let's do it. Adjustment number 2 was about inventory. You have the question? Students, you have the question? Please. Adjustment number 2 was about inventory. See, wait. See, adjustment number 2 was about closing stock. See this. Wait. So you have already closing inventory of 5,700. What was the cost? What was the cost? It was 980. 980 was the cost. Remember, I told you 700 units. 700 units times 1,400. And what was the NRV? Can anybody tell me the NRV? Can anybody tell me the NRV? It was 840. NRV was 840. 840. NRV was 840. So hope you remember, inventory should be recorded. Inventory should be recorded at lower of cost or NRV. So how much adjustment is needed? How much adjustment is needed? Adjustment of 140 is needed. We have done it. We have done it, and now I'm solving it with the shortcut. There I told you with the long working. So let's calculate the difference. This minus this is 140, and now 5,700. Just sum these two, you will get 5,560. So your correct closing stock is 5,560. Your correct closing stock is 5,560. Correct closing stock is 5,560. I have already taught you. Don't feel as a stranger now. This we have done. Okay. And now this correct closing stock will be used at 2 places. Number 1, in the income statement, cost of sales working. And number 2, in the year-end SOFP. Number 2 in the year-end SOFP. Okay. Now, your third adjustment, my dear student, your third adjustment was about onerous contract. Remember onerous contract? So let's do it. Onerous contract. So you have price per unit was 450 was the original price. Additional cost was 600 something. So automatically 450, it's 1050. And selling price was, I think, 900. So what was the loss per unit? What was the loss per unit? The loss per unit was this less this. It's 150. Okay. Now what's the total loss? The total loss is how many units we had? 22,500 units. We had 22,500 units, but we'll write without 3 zeros. Okay. So 22, we'll do 22.5 times this 150. 3,375 is the loss. 3375 is the loss. Okay. The other option was penalty of 4,000. So we should go for lower off, right? We should go for lower off. So it's 3375. Now, how to divide it between current and non-current? How to divide it between current and non-current? Simple. 3375 is for 3 years. 3375 is for 3 years. So let's divide it by 3. Let's divide by 3. Divided by 3. 1125. And now this thing will be remaining thing. Wait. Equal to this times 2. 2250. Okay. Okay. Now all of you listen. In the balance sheet, we'll book 1125 provision in the current liability and 2250 as a non-current liability. Okay. And in the income statement, complete. In the income statement, complete 3375. Complete 3375. Complete 3375 will be added in admin expenses. Complete 3375 will be added in admin expenses. In admin expenses. Okay. Right. Did you understand, all of you? Please tell me. Did you understand? Please write on the chat box. Thank you. I've already taught you. I'm just doing it on Excel. We have done it already. Now the next thing is held for sale, already done. Next thing is held for sale, which has already been done. Let's do it. Held for sale. Listen. Adjustment number 4. What was the carrying amount? What was the carrying amount? It was 1500. Carrying amount ready-made given in the question was 1500. And now I would recommend you to direct book 400 impairment. Direct book 400 impairment. So what was the fair value less cost to sell at the year end? It was 1100. So let's calculate the difference of these two. Impairment is 400. Impairment is 400. Impairment is 400. Okay. And you know, this asset was sold just 1 day after the year end. 1 day after the year end. That means not sold at the year end. So at the year end, this asset will be reported in current assets section as HFS 1100. Okay. This is the amount. This is the amount. This is the amount. Okay. Now the next thing is depreciation. Next thing is, brother and sisters, it's depreciation. What was the plant and machinery cost? Let me check. You have the question. I also have the question. Wait. The plant and machinery, it's 16,200. What was the cost of plant and machinery? It's 16,200. First, remove the held for sale cost minus it's, I think, how much? 2,400 is the held for sale cost. So you have 13,800. You have 13,800 as the remaining cost. Now, let's write the accumulated depreciation already given in the question is 7290. 7290. I hope you remember the accumulated depreciation of held for sale was 900. So it's 6390. Okay. Now, what is the remaining net book value? What is the remaining net book value? See, this is the remaining cost. This is the accumulated depreciation beginning. So let's calculate first of all this minus this. First NBV, opening NBV you have calculated. Now calculate the depreciation expense for the year. Now calculate the depreciation expense for the year. Do you guys remember the depreciation expense? It was cost, remaining cost times 15%, 0.15, remaining cost times 15%, remaining cost times 15%. Remember? So it was 2070. And what is going to be the final NBV? It's 5340. 7410, 5340 is the final NBV. 7340 is the final NBV. Okay. Final NBV, and this is of plant only. Plant only. Plant only. If somebody wants to add land as well, so if you add land, you know, you don't depreciate land. What is the value of land? Is 45,000. The value of land is 45,000. So finally, what will be the total? What will be the total? I just taught you this. Remember the land thing as well. That's it. That's it. Have a look. Have a look, please. Okay. I would request one thing. Listen, please don't mind. You are doing this question second time with me. I've already taught you one time. I have already taught you one time. This is the second time I'm teaching you this question. Now, all of you tell me one thing. This depreciation of 2070 will go in the cost of sales. This depreciation of 2070 will go in the cost of sales, right? And this impairment, look at here. This impairment will also go in cost of sales. Impairment for the year and depreciation expense for the year both goes in cost of sales. Both goes in cost of sales. Now I'm going to tell you $1 million thing, important thing. If you have question, please take out the trial balance, because now I can't show you the question here. I don't have question in laptop. It was on iPad. See the trial balance. All of you, listen to me. See the trial balance. See the trial balance of your question. You have the question. And now listen my words. Normally in 90% or 95% question of F7 FR level, they give you ready-made cost of sales. Normally in 90% or 95% questions of FR level, they give you ready-made cost of sales. But you remember, my dear students, when you were in F3 level, when you were in FA level, you used to calculate cost of sales as opening stock, add purchases less closing stock. Opening stock, add purchases or production cost is same thing. Add purchases or production cost less closing stock. Remember? So sometimes, listen to me. Sometimes what happens, your examiner takes you to the basic level, and sometimes examiner expects you to apply complete formula. Sometimes examiner don't give you ready-made cost of sales. Sometimes examiner don't give you ready-made cost of sale. Like in this question, go and see the trial balance. In the trial balance, there is no ready-made cost of sales. But yes, in the trial balance, you have opening stock. Check the trial balance. Don't look at me. Look at the trial balance, please. Look at the trial balance. In the trial balance, you will see opening stock. You will see closing stock, although the closing stock is wrong, which we corrected. The closing stock is wrong, which we just corrected. And you will see a production cost. Production cost is like purchases, okay? So in this question, you have to apply opening stock, add purchases less closing stock formula. I hope you guys understood the game of examiner. If you guys understood this thing, please comment, then I'll solve it. Comment. Yes, production cost is purchases. If you are doing a manufacturing business, then production cost and purchase is same thing. Did you see this? Yes, the depreciation will also adjust in cost of sale. Don't worry. But I was telling you the basic things about cost of sales in this question. Okay. Now let me calculate cost of sales for you guys. Let me calculate cost of sales for you guys and keep the question with you. That's why I told you to keep the question. See on the screen how much opening inventory you have. You also keep the question with you. Then it will be easier for you. If you have the question, then it is easier for you. Please. You have how much opening stock is there? Opening stock is how much? Wait. Yes, inventory at 30th June, X1 is 6850. 6850. Opening stock is 6850. Oh, sorry. 6850. Then what is the production cost? The production cost is 60150. 60150. Then closing stock. I calculated for you is the closing stock which I calculated. Wait, let me take you to the closing stock. This is the closing stock 5560. Remember this closing stock. Now, next thing is depreciation charge was 2070. Depreciation charge was 2070. Remember, and we have to add depreciation. You have done 10, 15, 20 questions of final accounts. If you are honest students, and if you have honestly done the exam kit, and if you have taken the classes, that means you have done 15 to 20 questions of final accounts. How much is the impairment? Impairment is also expense and it should also be added. So now let's calculate the final cost of sales. Let's calculate the final cost of sales. 63910. 63910. Giving you 30 seconds to look at it. 30 seconds. You got it? You got it. Okay. So cost of sales is done. Now, what else is left? What else is left? We have already done. Look at here. We have already done adjustment number 1. Adjustment number 2. Yes, inventory adjustment is done. Adjustment number 3 already done. Held for sale done. Depreciation done. Yes. And the tax adjustment is not directly, you can do it. Okay. So now the last round, the easiest round, let's make the income statement. Let's make the income statement. But one thing, keep it clear that keep the question trial balance with you so that it will be easier for you to do it. Okay. Okay. So we have Okay, this is your income statement. The first thing in front is revenue. Revenue you have to pick directly from the income statement. Revenue you have to pick directly from the income statement and from the trial balance. Sorry, it's 97,400. No adjustment of revenue in this question. Then you will write minus and the cost of sales. Let's pick the cost of sales. This is the cost of sales. Come on, this is the cost of sales. Okay, next. Now let's calculate the gross profit. Okay, now you have admin expenses. Now wait, what is the ready-made admin expenses number? Sorry, distribution cost. Distribution cost is distribution cost. There is no adjustment for distribution cost. There is no adjustment for distribution cost. Write it directly. But yes, for admin cost, there is some adjustment. Already the admin cost is 29750. Already the admin cost is 29750, students. Plus, look at here. Remember, there is an onerous contract provision. Onerous contract provision. And in the, you can see the question, you have the question. In the adjustment number 3, it was written clearly. It was written clearly that onerous contract provision will go in admin expenses. It was written very clear, very clear. So it was plus 3375, plus 3375. Just this is just for the presentation. Okay, now I'm doing it here. 29750, then minus how much? 3375. Okay, this is now what is the finance cost? The finance cost already given in the question was 750. The finance cost already given in the question was 750, and we corrected how much? 350. We reversed 350. Okay, so the correct finance cost is 400. The correct finance cost is 400. Okay, now go for the loss before tax. Wait, from this GP to 1, 2, 3, 4. See this. 7235. Wait. Okay, wait. My one mistake. This is 29570. This is not 29750. It's 570. It's my error. It's 570. Okay, transposition error. Let me correct it here as well. 29. Wait. 570. Sorry. Now, how much was the income tax? How much was the income tax? Income tax is not expense in this question. In this question, income tax is your income, not expense. So don't write it with the negative sign. It was 2530. It was 2530 income tax. Okay. Now, what is your final loss for the year? This is 4525 is the final loss for the year. Done. Income statement is done. Income statement is done. Done. Income statement is done. Onerous contract provision is not 1125. That was current liability. My dear students, we broke the total provision in current and non-current, but yes, the total provision is booked now because the obligation has arisen already. So the total expense is 3375. Okay. Now the next thing, my great students, next thing is SOFP. It's not difficult. Don't make a negative perception, please. Support yourself psychologically that this is not, and honestly, this is not difficult. You can ask anybody, this is not difficult. Now, let's move to SOFP. Okay. So In the SOFP, you can write plant and machinery and land together as well, or you can, if you want to write separately, it's okay. So it will be like, wait, let me find the working. This is plant, and what about the land? It's 45,000. 45,000 was the land. That's it. Now current assets, trade and other receivable, trade and other receivable, trade and other receivable, trade and other receivable. Just think, use your brain. Any adjustment did we do for trade and other receivables? Have we done any adjustment for trade and other receivable? Tell me. How much is the trade and other receivable? It's 25010. It's 25010. Now, remember I told you the current tax receivable. This time tax is not liabilities. This time tax is receivable. Remember? So how much was the tax receivable? It was 2530. 2530 was the tax receivable. Then you have a bank balance in the question as well. Go and check in the trial balance. Go and check in the trial balance. It is on the debit side. You have a bank balance of 4700. Then remember, non-current asset held for sale. Non-current asset held for sale goes in the current asset section. And in this question, it was 1100. Now the last thing is closing stock. The correct closing stock is 5560. Let me tell you one thing. Actually, somebody ready-made typed this for me. Inventory should come first. Inventory should always come first in current asset, but somebody already typed this for me. So right now, keep this thing in mind. When you go in the exam, write inventory on the top. After current assets, write inventory on the top. Okay, come on. Now go and calculate all this. 89240, 89240, 89240 is your current, is your total assets. 89240 is your total assets. Somebody has asked the question, if we didn't write inventory on the top, yes, there is a possibility that they cut some presentation marks. So it's better you write inventory first, because it's about the liquidity. It's about the liquidity. Always write bank in the end. Always write bank in the end, because bank and cash is the high liquid item. Okay. Now, next thing, come to the share capital. There are something you have to do it here. Listen. Remember, there was an error in the share capital. Students, there was error in the share capital. How much share capital was always there or already there? It was 29,600. Already share capital was 29,600, and I made the entry of 7,000 additional for share capital. Remember, plus 7,000. So 29,600 plus 7,000. 29,600 plus 7,000. This makes 36,600. Okay. Now share premium. Already, how much is the share premium? Already the share premium, or other component of equity and share premium is the same thing. Relax. In the question, sometimes they don't use the word share premium nowadays in the latest questions. So share premium and other component of equity, OCE, is the same thing. So in the question, you have OCE of 15,500. You have already OCE of 15,500. And 7,000 was the extra share premium. Remember? So this will be 15,500 plus 7,000. 22500. Now, hope you remember, retained earning is the easiest thing. In the question, you are always given opening retained earning. In the question, in the trial balance, you are always given opening retained earning, and normally we add profit in opening retained earning. Normally we add profit in opening retained earning. But in this question, you don't have profit, you have loss. You have loss. So how much is the opening retained earning? It's 11,470. Opening retained earning is 11. Opening retained earning is 11,470. Sorry, 11,470 minus the loss is 4,525. 4,525. Okay. So now let's apply equal 11,470 minus 4,525. This is 6,945 is your 6,945 is finally your retained earning. Let's add the total packet. This is your total equity. Now wait 1 minute. Now wait 1 minute, please. Look at the screen. Look at the screen for 1 minute. Now remember onerous contract. In onerous contract, 1125 was current and 2250 was non-current. Hope you remember. And the correct bank loan, listen, the uncorrect bank loan was how much? Tell me. Uncorrect bank loan was 30,000 and the correct bank loan was 16. Okay, remember? So it will be, if you add these two, you will get 17,125. 17,125 for non-current liabilities. Now come to current liabilities. In the current liability section, already you have 4,170. Already you have 4,170. 4,170 as a trade and other payable. But remember, there was some mistake in accrued. There was some mistake in accrued interest, and accrued interest was part of this other payable. Remember 350. Remember, you corrected 350. Hope you remember. Hope you remember adjustment number 1. In the adjustment number 1, you reverse the accrued interest of 350. Okay, it's 4,170, right? So now you have everything with you. You have everything with you. You have total equity. You have non-current liabilities as well as current liability. Let's add these three. This first one plus this plus this. Its balance. Its balance finally. Finally, its balance you can see on the screen. Finally, its balance you can see on the screen. Okay, sorry. Yes, I switched the liabilities. Sorry, it's my mistake. Wait, I wrote non-current liability. Sorry, you are right. Wait, it should be 2250 here. And sorry, it's my mistake. And this should be 1125. Sorry, you are right. Still the answer will remain same, but this is a mistake. This is a mistake. Yes, you can, anybody can do it. Hope you got it. Did you understand the question? Sorry, I shuffled current and non-current of onerous contract. Did you understand the question? Tell me. Sir, if we do this mistake, or 1 mark, yes, 1 mark or 0.5, 0.5 mark. If you do this mistake in the end, listen. You have done correct in the adjustment section. In the adjustment section, you write correct current liability and no. But here, if you do mistake, maybe examiner don't cut the marks, or if examiner didn't notice, he will cut 0.5 marks for this. 0.5. Now, finally, all of you All of you, please comment. Did you understand the question? Did you understand the question? Don't worry about this Excel file. I'll send you. Don't worry about the Excel file. All of you now write on the chat box. The chat box is in front of me. Did you understand the question? Okay. Now let's take a break of around 10 to 15 minutes, and then we'll come back and start the ratio analysis question. Okay. Don't run away. Take a break. Now wait. Okay. Welcome back. Welcome back, students. Now we are moving towards the next question, please. That's the ratio analysis. Be very active because now you should be very fresh. You have taken a break. Let's start. It's this ratio analysis is linked with consolidation. Ratio analysis is linked with consolidation. Venus company, Venus is the parent company. Venus is the parent company, acquired 70%. 70%, that means 30% is NCI of the equity share capital of Luto company. This is subsidiary. This is subsidiary on 1st January X8. On 1st January X8. Now wait, what is the year end? 30th June X8 is the year end. 30th June X8 is the year end. That means we acquired this company in the mid of the year. We acquired this company in the mid of the year. The new subsidiary is acquired in the mid of the year. Don't forget this thing. Okay. On reviewing the consolidated financial, see the word, the consolidated financial statement. On reviewing the consolidated financial statement, the managing director of Venus company was disappointed, commenting that he had expected to see higher gross profit for 2008 due to the receipt of discounted purchases from Luto company in the post acquisition period. Now, this managing director is a big stupid. He doesn't know the accounting. He doesn't know the rules of consolidation. I'm sure you all guys have done ratios by now. And in the ratio analysis, I teach this question in class. Gregory. This question is like Gregory question. This question is like Gregory question. Remember? Now, just think, you know, why Venus company took over this Lotus company? Because parent company, the parent is Venus. Parent company wanted to buy the discounted products. The parent company wanted to buy goods at a discounted rate, and they did so. They did buy goods at a discounted rate. But they are saying that in the consolidated books, why we can't see the benefit? In the consolidated books, see the word. In the consolidated books, I can't see gross profit rising. You know why? Because in the consolidated books, intercompany transactions are cancelled out. S to P and P to S sales are cancelled out. So how can you see in the consolidated books, S to P and P to S sales are cancelled out? So how can you see? So this MD doesn't know the accounting. This MD doesn't know the accounting rules. Okay. So you just picked 1 or 2 marks. You just picked 1 or 2 marks in this first paragraph. In the end, you have to write this on the comment section, right? Okay. Next, he has remarked that the acquisition of Luto company has not had the positive impact he expected. Now, one more thing, this MD is saying that the subsidiary, we don't like this subsidiary. The subsidiary is not good as we were expecting. That means they are thinking that the profitability of subsidiary is low. So we need to find in this question that is he correct? Is he correct that the problem is in subsidiary, or the problem is with the parent company, That's the point. Okay. So we need to find out this thing, and we will find out. Okay. Now what things are given in the exam? Extract of the draft financial statement of Venus Group and Venus Company single entity for the years to 30th June X7 and X8. Now just use your brain. This year we acquired, this year parent company acquired in the year ended X8, June X 30th June X8, parent company acquired the subsidiary company. So this year we have consolidated. See, this year we have consolidated data, but the last year the data is single company. So now just think, last year is single company and this year is consolidated company. So this comparison is not like with like. Last year is single company and this year is consolidated. One more thing. We are right now doing income statement. Income statement. Don't forget, income statement is always for the year. Income statement is always for the year. So in this for the year, as they have given you for the year income statement consolidated, they must have consolidated only 6 months data of S company. They must have consolidated only 6 months data, because the takeover date is the mid of the year. The takeover date is the mid of the year. Just use your brain. Wait, look at here. This is your accounting period, which is 30th June X8, starting on 1st July X7. And you know the takeover date is 1st of January X8. So they must have consolidated 6 months. 6 months sales, 6 months cost of sales of S company. Okay. So in this consolidated income statement, only 6 months data of S company is added. You guys know this accounting now. Now, next, have a look. Now, in the end, they have given you the breakup as well. In the end, they have given you the breakup as well. Profit attributable to equity owners of P company and NCI. Now, one thing I would like to highlight. Last year, parent company's profit, when parent company was alone, the final profit was 8,900. And now the share of parent company's shareholder is only 9,200. Last year, when parent company was alone, at that time, the profit was 8,900. Alone profit of parent company, and now parent plus subsidiary, but again the parent share of 100% parent plus 70% subsidiary is only 9,200. So the profit increased by only 300. Just think, the profit increased by only 300, whereas check it, the sales increased by 7,000. The sales increased by 7K. The sales increased by 7K, but the overall profit related to the parent company only increased by 300. So this is something worrying. This is something worrying, right? Now, you can see students, you have last year the share capital was 20. This time it's 30,000. So there is an increase of 10K share capital. Last year share premium was 5,000, now 35,000. So 30K is the increase of share premium, and the remaining is retained earning. And obviously now you have NCI. In the equity section, you have NCI as well. In the equity section, you have NCI as well. Okay. Definitely now the consolidated data is given. Are you getting? Don't sleep. Next, the acquisition of Luto company has been accounted for correctly in the above financial statement extracts, and the following notes are relevant. Number 1, Luto company, which is subsidiary, recognized revenue of 5 million in the post acquisition period and resulted in the profit of 2 million. Now, what does it mean? Listen, in the last 6 months, look at here. In the year ended 30th June X8, we only included the last, we must have included the last 6 months data of S company. We must have included the last 6 months data of S company in the income statement, consolidated income statement. So the last 6 months sales was 5,000. Last 6 months sales was 5,000. So in this 39,000, 5,005K related to S company. in this 39,000, in this consolidated income statement, sales revenue of 39,000, 5,000 related to S company. This thing is clearly written in the notes. This thing is clearly written in the notes. No, don't sleep. Please don't sleep. And you know, the separate profit of this 6 months is 2 million. The separate individual S company's profit is 2 million. Definitely it is included in the consolidated books. Definitely, as the consolidation has been done, so it is included in the consolidated books as well. Next thing, since the acquisition of Venus company is able, since the acquisition Venus company, Venus is P company, Venus means P company, okay, is able to acquire goods from Luto company at a discount, this has resulted in saving of 500,000 for Venus company in the post acquisition period. Now at 30th June X8, Venus had no inventory that had been purchased from Luto company. That means no unrealized profit. What does it mean? Whatever S company sold to P company, just think, whatever S company sold to P company, whatever goods S company sold to P company sold it to the third parties. So all the profit was realized. There is no unrealized profit. And when there is no unrealized profit, that means all these 500,000 savings, has been realized and is included in the consolidated books. You are not getting. My dear student, this is the most technical point of this question. You know, as they have written that the consolidation is done correctly. Consolidation is done correctly by the accountant with perfect rules. So right now they are saying that there is no unrealized profit. There is no unrealized. Had there been any unrealized profit, then definitely it was removed. But as there is no unrealized profit, that means this benefit of 500,000 has been realized by the group. This benefit of 500,000 has been realized by the group, and this is included in the income statement. And this 500,000, this 500K savings are reflected in the net profit. They are already reflected in the net profit, my dear students. Read it and think over it. Don't sleep. Think over it, please. There is no URP. There is no unrealized profit. All the goods are Venus had no inventory left in the end. Parent company has no inventory left here. So that means everything is sold to the third party. So all the profit has been realized. And when all the profit has been realized, that means this earnings, this savings of 500,000 has already been reflected, already been booked in the consolidated income statement. And that is a genuine thing. No mistake. But just for your remembrance, because something I will teach afterwards after 10 minutes. This 500K has already been booked in the income statement. Yes. Now, the consideration for the acquisition consisted of a share exchange. Yes, the consisted of a share exchange. The COI, the cost of investment, consisted of a share exchange. You can see this 40K. This 40K, we have issued new shares. We have issued new shares of 40K to the owners of S company. Okay, owners of S company. This is one, and an additional 5 million to be paid on 1st of January X9. On 1st of January X9. That means this is deferred consideration. You promise to pay for deferred consideration. This is very interesting. Venus company has a cost of capital of 8%, which is equivalent to a discount of 0.926. Now, wait, let me tell you. in a in very basic language. This is 1st January X8 takeover date. This is 1st January X9. Something extra I'm doing. After 1 year, we have to pay 5,000. After 1 year, we have to pay 5,000. Okay. 1st January X8 and 1st January X9, the difference is 1 year. Okay. So first of all, calculate the present value. Deferred considerations are always recorded at present value. So present value will be 5,000 times 0.926. 5,000 times 0.926. Somebody help me with the number. Present value will be 5,000 times 0.926. What is the number? 46. How much? How much? 4630. 4630. Okay. So your liability, your deferred consideration liability, don't sleep. Your deferred consideration liability is 4630 at 1st January X8. Now, you know your year end. Your accounting period year end is 30th June X8. If you are not sleeping, and you have carefully seen the question, your year end is 30th June X8. So in this consolidated income statement, you should have booked 6 months interest. In the consolidated books, in the consolidated income statement above, the accountant has correctly booked the 6 months interest. 6 months interest. Can anybody calculate the 6 months interest? Yes. What is the amount of liability? 4630. The amount of liability is 4630. The amount of liability is 4630 times 8% times 6 upon 12. This is 185. 185. So now use your brain. Whoever made this consolidated income statement, whoever made this consolidated income statement must have booked 185 interest expense, and this has already been booked. This has already been booked because it is written. Because it is written correctly. It is written correctly. See the screen. Correctly. Correctly. So I have explained you point number 2 and point number 3. Now point number 4. You are expert. See, the examiner is testing your consolidation skills here. Examiner is testing your consolidation skills here. I'm sure you are active. The fair values of Luto is subsidiary. Assets at acquisition were almost equal to their carrying amounts except for an item of plant. See, now he will test the upward fair value adjustment. This plant had a remaining life of 3 years. At the date of acquisition, its fair value of 900,000 above the carrying amount. Above the carrying amount. So it's upward fair value adjustment. And how much life is left? It's 3 years. 3 years. 3 years life is left. Can anybody tell me the excess? Can anybody tell me the extra excess depreciation of this fair value adjustment for 6 months? For 6 months, because takeover date is, don't forget. See, in the examiner report, they have written, these are the small mistakes students do. These are the small mistakes students do. Like 6 upon 12, 9 upon 12. This is the thing they do. So your fair value adjustment is how much? It's 900 into, so 900 divided by 3 will give you per year depreciation. 900 divided by 3 will give you per year depreciation, and times 6 upon 12. 900 divided by 3 will give you per year depreciation, and times 6 upon 12. How much is this? 150. So this is excess depreciation. And yes, if you are active, why 6 upon 12? Why 6 upon 12? Because the takeover date, listen, the takeover date is 1st January X8, and your accounting period income statement is ending on 30th. You are making your income statement on 30th June X8. So only 6 months excess depreciation. Only 6 months excess depreciation, which is 150. Only 6 months excess depreciation, which is 150. And yes, excess depreciation is one of the expense of consolidated books. Excess depreciation is one of the expense of consolidated books. So again, I'm telling you, whoever has made this consolidated income statement must have booked this 150 extra depreciation expense. Depreciation is expense. Hope you are active. And this is also expense. C, 185 interest is also your expense. 185 interest is also your expense. Yes, excess depreciation has already been booked because why? In the question it is written correctly. See, correct accounting has been done. Accountant has done correct accounting, and whoever does correct accounting of consolidation in the income statement must always book excess depreciation if there is an upward fair value adjustment of a depreciating asset. If there is an upward fair value adjustment of a depreciating asset. Okay. Now, one very special thing examiner will do with us just for these 1, 2, 3, 4. Just for these 1, 2, 3, 4, examiner will do something very interesting with us. Now, see this. The following, see the next thing. The following pre-formatted table relates to part B1. It is related to a requirement. It is related to a requirement. They have given us ready-made. You have to write this to be calculated, to be calculated, to be calculated. I will do it for you. Very interesting thing. In this question, we have to move. In this question, we have to move from group accounting profit to individual accounting profit. In this question, we have to move from group accounting profit to individual accounting profit of P company. Group accounting profit of P company to individual accounting profit of P company. Now next, very simple. Requirement number A is the total free. Do you have heard about the free? Have you seen the free goods sometimes distributed? Charity goods. This is charity. Requirement number A is a pure charity by examiner. Pure charity. This is called pure charity. Take it. Now, based on the extracts provided, see, this is basic English. Extract provided means ready-made data. Extracts provided means ready-made, whatever data given in the above income statement and SOFP. Use the pre-formatted table to calculate the following ratios for Venus Company and Venus Group for the year ended 30th June X8 and 30th June X7 respectively. You have to calculate GP percentage, NP percentage, and return on equity, and say thanks to examiner. See this. Say thank you to examiner. Equity should also include NCI. Openly they are saying in the equity packet you should include NCI as well. You should include NCI as well. Openly they are saying. Okay. So now I'm giving you these three ratios. GP percentage, GP upon sales into 100. GP percentage is GP upon sales into 100. NP percentage is NP upon sales into 100. And ROE, return on equity, is net profit upon equity packet into 100. Net profit divided by shareholder equity into 100. These three things you have to calculate from the above data on the first page. And you have also the question. I'm just moving you towards the first page of the question and giving you 3 to 4 minutes. 4 minutes are enough. See this. Just this data. Okay. Just this data. Use this data, please. Use this data. Thank you. Calculate. Come on, start, please. Use total net profit. Use total net profit, okay? Because in the denominator as well, you will take NCI. In the denominator, you will take NCI as well. See, this is the shareholder equity for last year. This is the shareholder equity for last year, and this is the shareholder equity for current year, including NCI. 87,500 includes NCI. 87,500 includes NCI, please. Sure. Now, I'm sure you have the question, okay? I'm sure you have the question. You have the question. I've already sent you on WhatsApp as well. So let me write the numbers now. For 2008, it's, wait, the gross profit was 12,500. Sales was 39,000 times 100. This makes around 32.1%. Simple data, simple data from the extracts. Last year, your GP was 11,000. Your sales was 32,000 times 100. It's 34.4%. Okay. Now, what is net profit margin? Net profit is after deducting all expenses, final net profit. So net profit was 9,800. Sales is 39,000. It's going to be 25.1%. Then you have 8,900 for last year net profit. Sales is 32,000 times 100. Okay. Now return on equity. Return on equity. Again, you have to use the same net profit, which is 9,800. And you know, I just highlighted you the shareholder equity packet. I just highlighted you the shareholder equity packet. Remember, in the shareholder equity, it was 87,500, including NCI. %11.2%. Okay. Then you have last year 8,900. See, these are the ready marks. And you know, you have to catch these ready marks because your first target is 50. Although I've showed you scores of 89, 87, 88, okay, leave it. First target is 50. So get the cash marks first of all. You all understood? Now the second requirement is the only requirement which needs your little brain. And now wait. Let me make your mind. Always get ready to do some charity in the exam. Charity, yes, it's a 20 marks question, 2 marks charity. Another requirement, 1 mark charity, 2 marks. If you get 10 marks out of this 20, still you are good. This is last 40 marks, the most technical area of examination. If you get 50% marks from these last areas, still you are good. Still you will win. That's it. This is the approach. Now the next question, next requirement is very good. Try to understand it yourself. Complete the table provided. Have you seen one table? The table which I showed you, this table. See, this is the table. This is the table. Complete the table provided to adjust Venus Company's consolidated profit for the year ended 30th June X8 in order to calculate the profit of Venus Company for the year, as if the acquisition of Luto Company had not taken place. Reverse working. They have given you in the second year, listen, in the second year, they have given you the consolidated profit. That means with Venus plus Luto Company. Venus plus Luto Company. They are saying just remove Luto Company. Everything related to the consolidation, just remove it. Everything related to the consolidation, just throw it out. Just throw it out. Okay. So everything related to the consolidation means S company's profits, S company's expenses, S company's additional excess depreciation, S company's takeover consideration, interest on deferred consideration. Remember, interest on deferred consideration is also a consolidated related expense. Fair value adjustment depreciation is also consolidated related expense. And subsidiary company data is also consolidated, and subsidiary company's profit is also consolidated related thing, because you know in the last you added S company for last 6 months. You added S company for last 6 months, my dear student. Okay, so you need to remove S company's profit for last 6 months. Now your answer should take account of the information provided in the notes. Your answer should also recalculate the net profit percentage. This is my target. NP percentage is equal to NP upon sales. But use your mind that you are working for individual books of P company. You are working for individual books of P company. You are going to work for individual books of P company, individual books of P company. Are you getting? Okay. Now still, I have already told you a lot of things, but again, I'll tell you something more. Let me move the screen. See, you have to see these 4 points. These 4 points are very valuable now. These 4 points are very valuable. First of all, in the last 6 months, how much is the profit? In the last 6 months, how much is the profit of S company? See the note number 1. In the last 6 months, how much is the net profit? How much is the profit of S company? 2 million. So when you have added everything, sales, cost of sale, everything, that means ultimately you have added the profit. In the final figure, you have added the profit, and this profit is 2 million. So 2 million is added in the profit. So now you have to subtract it. 2 million, this 2 million or 2000, this 2 million or 2000 is the profit of S company, which has already been added in the consolidated book. So you have to subtract it, and say thanks to examiner. Examiner has shown this to you. Examiner has did this for you. See, the first adjustment minus 2000, he has already done with for you. He has already done this for you. See, the first push, the first free push is by the examiner. The first free push is by the examiner. Things are free also in the exams, although they charge examination fees and the pound rate is high, but they push you. Now, what else you can do? Just one word from my side, please. If there is any benefit of consolidation, listen, if you get any benefit of consolidation, that means an income type thing, you have to deduct. And if there is an expense type thing, you have to add back. If there is an income type thing from this consolidation, see, we have to do working like there is no consolidation, there is no Lotu company, there is no this company. So whatever has done, you have to reverse. So if you get any benefit, If you get any benefit, subtract it. If there is an expense or loss, add it back. So in point number two, see this 500 is a benefit. This 500, my dear student, is a benefit. Discount is a benefit. So this has already increased your profit. So now let's decrease it. This 185, see point number three. The interest, or what's the name? Unwinding of discount or interest is an expense. So now you have to add back this 185. And yes, this 150 excess depreciation is also expense. So now you have to add it back. That's it. Let me do it for you. I have made the sketches for you. Wait. So adjustment number 2 was a benefit discount. So you have to subtract 500. Okay. Adjustment number 3 was unwinding of discount. I have already taught you unwinding of discount, right? 4600 times 8% times 6 upon 12. It was 185. Already taught you this 185. Okay. Then adjustment number 4 is excess depreciation. 900 divided by 3 times 6 upon 12. It was 150. Okay. So your final profit is 7635. This is your profit of individual books. 7635. This is your profit of individual books. 7635 is your profit of individual books. Now, net profit percentage. Again, I'm writing the formula net profit upon sales. Now, one tricky thing. What is the net profit? The new net profit is 7635. Now the last dodge is left. Yes, one guy is very active in your class. Last dodge is left. You have to work as if there is no consolidation. So where is the sales for 2008? Let me move the screen for you. Where is the sales? This is the sales. This 39,000 is the sales. Can you see? This 39,000 sales? Yes, you can see. But in this 39,000, 5,000 related to S company. So you need to remove this 5,000 from sales as well. Because you need pure parent company sales. My dear students. Let's do it. Okay. Times 100. How much is the percentage? Now make your mind for the commentary. This is the time you are doing and you are making your mind for the commentary. This is the technique of ratios. You are doing number crunching and you are thinking about the last part, which is the commentary. Now, this is the time to reply back the MD. MD was saying that subsidiary company is bad. MD was saying that subsidiary company was bad. Remember? Now wait. What is the individual return of parent company? This is 22.5%, right? 22.5% is the individual return. And what is the last year return? See, the last year return was 27.8%. The last year individual NP margin, students see 27.8%. When last year parent company was alone, last year parent company was alone and parent company was generating 27.8% NP margin. And this year parent company individual margin is just 22.5. We just calculated it. So see, there is a fall. If you compare individual books, there is a fall. MD is stupid. And yes, now you see, now you compare with this. Now you compare with this. That means subsidiary companies supported. Subsidiary companies supported parent company to maintain some margin. You're not getting, still you're not getting. Without subsidiaries, see the results fell down to 22.5%, from 27.8 to 22.5. So say thanks to subsidiary people. We should be thankful to subsidiary companies people that they supported us. They supported us. This is something, the scoring area of this question. If you forgot to write this commentary, that means now you should lose marks. These are the things. What I use my, I use sometimes the word digging. In ratio analysis, we dig down things and we unfold things. Okay. And now again, you will get gifts from examiner. Again, free marks. I'm sorry, let me use the word free marks. Very basic marks. Come on. Next. Explain. It's a general, for me, it's a general requirement. See, explain why consolidated financial statement, for example, those of Venus Group, for example, those of Venus Group are not comparable to those of single entity, for example, Venus. I have a general question from all of you. Why the individual books are not comparable with consolidated books? Why the individual books are not comparable with consolidated books? Because, listen, in the individual books, you have the data of P company only. In the individual book, you have the data of P company. Let's start with income statement. In the individual books of P company, you have the data of parent company's incomes and expenses. But in the consolidation, you have parent company plus subsidiaries. So here there is only one company. There you will see 2, 3, 4, 5 companies. So this comparison is not like with like. Simple. Number one. Number two, if you go for SOFP, yes, very good. If you go for SOFP thing, in the individual SOFP of P company, only assets, liabilities, and equity of parent companies are there. Only assets, liabilities, and equity of parent companies are there. But in the consolidated SOFP, you see parent companies plus many subsidiaries. If you have 2, 3 subsidiaries, assets and liabilities are there. And yes, for equity side, only post retained earnings of S companies are added, plus NCI. Plus NCI is also reported in equity sections because NCI guys are also owner. So again, this comparison is not like with like. Third thing. Let me come to the income statement. In the income statement, you cancel intercompany transactions. P2S sale. When parent company sold goods to S company or S company sold goods to P company, you cancel it. So in the consolidated books, you cancel the intercompany transaction. But in the individual books, you never cancel. So these two books are again not comparable. Data is different. Fourth point, come to the SOFP. In the consolidated SOFP, open your ears. I'm talking about F3 level consolidation, not F7. In the consolidated SOFP, you cancel intercompany receivables and payables. You cancel intercompany receivables and payables. You cancel intercompany receivables and payables. But in the individual books, you keep all these receivables alive. You keep all those receivables and payables alive. So my dear students, my respectable students, my innocent students, how can you compare these two books? I have given you 4 or 5 points and they are just asking 3 marks. They are just saying 3 marks. Okay. I hope this was general discussion. This was general discussion. You can read it. You can better read it, please. I have shown you the answer. You can read it, please. I have explained you. Yes, bank loans means intercompany loans. Only intercompany loans are cancelled. The first 2 lines are readable. Let me enlarge the second lines. First, read first 2 lines. Now read this. Now read this. Tell me, did you find this requirement difficult? It was general requirement. The difference between individual books and consolidated books. The difference between individual books and consolidated books, my dear students. Did you understand this requirement? See, this is the latest past paper. I am not teaching you 2008, 2005, 2006. This is 2022. The same 2022 past paper I am teaching you. The very latest fashion. This is called latest fashion. And you know, this is the positive point of F7, that F7 has a good pass rate. You know, normally F7, F6, these 2 papers, their pass rates are always 50%, 51, 49, like this. So in skills module, this is a good news. You know, if you are a serious student and if you have studied properly, normally there is a high chance that you can clear the paper, honestly. Now the last point is general. It's about the discussion performance of this question. Let's do it. Read the requirement and just help me with that. Okay, be active, don't sleep. Only 15 minutes I'll take max. Based on your answers to part A and B, based on your answers to part A and B, comment on the comparative performance of Venus company for the year to 30th June X7, X8, and specifically C. Examiner is saying, not I am saying, C, specifically addressing that fool, the managing director. C, specifically addressing the managing director, those free marks exam. Remember, managing director was saying 2 things. Number 1, that why the benefit of discounts are not, I can't see. I can't see the benefits of discount in the consolidated books. So we said in the consolidated books, we cancel. In the consolidated books, we cancel intercompany transaction. How can you see? How can you see? And number two, the managing director was criticizing the subsidiary company. The managing director was criticizing the subsidiary company. Remember, subsidiary company's performance is not bad. It's basically the parent company who is responsible. Parent company is responsible for this downfall. Even subsidiary company helped us. Subsidiary company helped us to maintain some of the ratios. Okay. Now let's discuss it. Now wait. First, make your mind. This was 20 marks question. So far you have done 11 marks. So if you can score 8 marks from this 11, so it's okay. From the remaining 9 marks you score 5. That's it. That's okay. We don't want 100 marks. I don't want 100 marks from anybody of you. I want all of you to pass. For example, if I have two options, that my 50% students score 90 plus or my 100% students score 50, I will go for the second option, because the pass is everything, because I know the reality. I know the reality of job market, and I know the reality of your investment, that how you guys are paying the tuition and examination and all. So the real thing is 50. And I always say this, that right now it's high inflation time all over the world, not for one country, all over the world inflation is high. So you guys should not fail now. At least you should support your parents in this way. If you can't do job, if you can't earn, at least control these expenses. At least this is the least thing. I think least. Okay. Now see this few points I have already raised. You can see the sales from last year to this year. The sales from last year to this year increased from 32 to 39,000. If you compare these total books, 32 from 39, 7,000 sales increased by 37,000. Okay, but the final net profit for parent company's shareholders, just increased by 300. So that means not major impact on bottom line. No major impact on bottom line. Keep this thing in mind. Okay. Now, if you look at the GP percentage, what were the GP percentage? Wait. GP percentage was, previously it was 34%. Now it's 32.1%. Previously it was 34%. Now it's 32.1%. 34 to 32.1%. So GP percentage also went down. GP percentage also went down. Now these GP percentage has nothing to do with intercompany transaction. These GP percentage, the second year GP percentage has nothing to do with intercompany transaction, because in the consolidated books we cancel the intercompany transaction. So there is a downfall. The reasons may be, why GP percentage went down. You might have reduced the prices, or your cost have gone up, These are the reasons. Okay. Then one more thing. See the net profit percentage I have already discussed. Last year, the NP percentage of parent company, single parent company, was 27.8, and this time it's 25.1%. Okay. This time it's 25.1%. This time it's 25.1%. Okay. So looks like there is a fall. But if you see the real picture, if you see last year individual results with this year, so you will see 27.5 to 22.5. 27.8 to 22.5. That means you can openly see this, that it is the parent company who is responsible for the bad performance, not the subsidiary. It is the parent company who is responsible for the bad performance, not the subsidiary. Even subsidiary company supported us. See, parent plus subsidiary is equal to 25.1. Alone parent company in 2000x8. Alone parent company in 2000x8 is only 22.5. So we can see this picture. I have one more evidence. Wait. Excellent evidence I can give you. See this. If you see alone, see S company's 6 months profit was 2 million and S company's sales was 5 million. So 2 divided by 5 into 100, it's 40%. See, S company see S company's last 6 months sales is 5 million, last 6 months profit is 2. So alone 6 months NP margin is 40. Although first 6 months data is not given, but still S company is doing better. These statistics show that S company is better than P company. Okay. Now two more things which I taught you already. See, this is the repetition. Two more things which I have taught you already, and that is I taught you in Gregory. If you have done my lectures, or if you have done the exam kit, there is a question Gregory, the same commentary I taught you guys in Gregory. Now I'm teaching you again. Listen, you know ROE. What is ROE? ROE, net profit upon equity. Net profit upon equity. You can see a major downfall. You can see a major downfall in ROE. You can see a major downfall in ROE from 21 to 11%. Did you see? You see a major downfall in ROE. What was the reason? Why ROE came down? Why ROE came down? The first component is net profit. See, the first component is net profit and the second component is equity. See, net profit increased from 89 to 9800. Can you see? Net profit increased from 89 to 9800. So there is a slight slow. There is a slight increase in net profit. But you know what is the bad news? There was a very big jump. There was a very big increase in equity. See, 42,000 from it. From 42,000 to 87,500 is a big jump. So the real reason for fall in ROE, a real reason for fall in ROE, a real big reason for fall in ROE is not the numerator, it's the denominator. The real big reason for fall in ROE was not numerator, it was denominator. I'm using the mathematical language. I'm sure you're understanding it. Now, one very excellent commentary I can tell you, it's excellent marks because you have already done it. See, this is the second time you are doing in your life, or in the third time. Because when I give the general lecture of ratio, I discuss this. In my general ratio lecture, I discuss this. Then in the Gregory question, I discuss this, and now I'm discussing it third time. You know the meaning of timings of investment. You heard about timings of investment issue. Let me tell you. See this. Students, see this. We included in the denominator of ROE, we included this complete equity. See, we included complete 87,500. In the year ended 2008, in the year ended 2000x8, we included complete 87,500. We included complete 87,500 equity in the denominator, complete, all share issue and everything. But in the numerator, we have only included 6 months profits. We have only included 6 months profits. You are not getting. In the numerator, we have only included 6 months profit, but in the denominator, we included the complete equity. Not getting, sorry. See, we issued some big shares. We issued some new shares to acquire this subsidiary. So our share capital and share premium, these things increased. And we simply took the closing balances. In the ROE calculation, we simply took the closing equity. So denominator went up suddenly. Denominator went up in one go. But in the numerator, when you take profits, so you have only included 6 months profit of this subsidiary. So this comparison is not like with like, that's why ROE went down. So wait for the next year. Wait for the next year when you will be seeing the full year results. Wait for the next year when you will be having the full year results. I'm sure you remember this commentary when I taught you in class. I teach this thing in class. If you see my class, then I feel like you keep 2 laptops with you. One with my class and other is movie. You just shift just to show your parents you guys watch my lectures. Are you getting? Yes, multitasking. Sorry, no 2 laptops, just switching the window alt button and shift the screen. But also this is also a need. Yes, alt tab. This is also a need. I can understand you guys are 18, 19, 20. This is your age. I can understand. Okay, so you have to write this issue as well. One more issue, which is very technical issue, you can also write. That was also in Gregory. That is very technical, and that is not everybody. Even examiner has not written that comment in the answer. In the extra comment, examiner said that you can write, but right now I'm in the mood of teaching, so I can teach you. Listen. Can you see any revaluation reserve? Oops, just let me increase the equity packet. Can you see any revaluation reserve in the parent company's books? Check. Can you see any revaluation reserve in the parent company books? No. That means parent company was using cost model. Okay. So just think. Look at my video now. Let me enlarge my video. Sorry. See. Look at here. Listen. Last year, students, parent company was alone. And parent company was using cost model. So in the cost model, there is no revaluation reserve for sure. So that means the equity levels were down. Equity levels were down. Okay. But this year, during this year, we took over. During this year, we took over subsidiary. And whenever we do take over, we have to do one mandatory revaluation. That is fair value adjustment. This is the rule of consolidation. When parent company acquires S company, parent company brings everything. Parent company brings everything of S company to fair value. So now during there is a revaluation. There is some upward revaluation. Which gives rise to more equity. So that's why equity went up. So ROE went down. And one extra thing you can also predict, if parent company would have been using revaluation model, if parent company itself using revaluation model, then there will be more reduction in ROE. ROE. See, I'm so loyal to ACCA. I use ACCA Cup. Think ahead. I'm so loyal to ACCA. See, think ahead. You know the logo? Now, let's move to the solution thing. I've tried my best. I've tried my best to explain you. Now let's read it. It's simple. It's simple, and don't take tension. And don't expect that you can write very extraordinary thing. Be a common man. Be a common man. To be very honest, you have to clear. The first target is passing. That's it. See, I have started with the note. Looks like Lotus is parent company. Performance is better, because this was the theme. Parent company is Lotus is subsidiary. Subsidiary company's performance was better than Venus company. As individually, Lotus company made a profit of 2 million in last 6 months. This suggests that Venus overall profits went down significantly. See, in the last 6 months, in just use a rough calculation. Venus made 2 million profit in 6 months. Sorry, Lotus. Lotus means subsidiary made 2 million profit in 6 months. So that means what should be the full year profit of subsidiary? Just assume it. 4 million. Repeat. Lotus made 2 million in 6 months. Lotus means subsidiary made 2 million profit in 6 months. So what about the full year? Full year is 4 million. 4 million. So out of 9800, just think 4 million relates to subsidiary. So that means the real profit of parent company was too much low. The real profits of parent company is too much low, and you have seen by calculating the separate profit. You have seen the parent company's separate profit with that reverse working. So the performance of parent company is not that much good as compared to subsidiary. Okay, this is the point. Also, overall revenue increased by 7,000. I just showed you the income statement, but P company's profit only increased by 300. P companies equity owners only get the net benefit of 300, which is not good. The decrease in GP percentage is mainly due to decrease in GP of Venus, because the performance of subsidiary is better. Venus individual net profit. This is very heavy point. Heavy. Venus individual net profit came down to 7365. This number, remember, from 8900. Last year, the individual net profit of Venus was 8900. You have the question, you can check. And this year through reverse working, the profit is 7635. So it's a significant downfall. Also, NP percentage came down from 27.5 to 22.5. See, I have written individual books comparison. Third time I'm telling you. That means Lotus supported a lot to maintain profit. That means subsidiary company helped us. Here. Okay. In 2008, there is a significant reduction in ROE from 21.2 to 11.2. This is the major event of this question. What is the formula of ROE? NP upon equity. This downfall is not mainly due to the net profit reduction, but the real reason for this is increase in equity from 42 million to 87.5 million. This I again showed you before 2-3 minutes. I again showed you. Read it and relax. Read it and relax. Now next, the timing issue. The timing issue I just told you. I just told you the timing issue. The denominator increase, the ROE denominator increase in one go, but in the net profit we only took 6 months effect. In the net profit we only took 6 months effect. Read it please. In the net profit we only took 6 months effect. Just taught you this. Okay, then one more issue, please. Fair value revaluation issue, fair value or revaluation issue. Parent company was using cost model, and at the date of takeover we have to bring subsidiary to fair value. That is a mandatory thing in IFRS 3 business combination. So that also impacted ROE negatively. Okay. Now, MD comments, the most easiest thing I've taught you in the first go. The most easiest thing is MD comment. MD is in two mistakes by MD. The first thing, in MD thought that the benefit should be reflected in the the benefits of discounts from subsidiary to parent, from S to P sales should be reflected in the consolidated books. This is wrong. Because we eliminate intercompany sales and all these things. Read it. MD is incorrect to be disappointed by this acquisition because the performance of Lotus is better than Venus, discussed above in the comments. Also, MD expectation of higher GP because of discount is wrong, because intercompany sales are eliminated from consolidated income statement. Okay, so both things of MD was wrong. Okay, are you getting? And finally, you can add one or two more points, that because of takeover, this is general point. Because of takeover, there will be some synergies, and in the long term, they can benefit. The Venus group can benefit from it. Okay, and in the conclusion, you can write that this takeover was not a bad takeover. Even this takeover of Lotus company supported the Venus company to maintain the ratios. Okay, in the end, you can write this. Okay. Now, I have already recorded all past papers. This is my routine. Listen to me. Whenever there is a new past paper came, in every 6 months they launch one past paper. This is the habit of ACCA Global. Every 6 months they launch one past paper. So since last 2-3 years, I have recorded all past papers. Even I have posted on YouTube as well. And in my LMS, they are also there. You can also watch all those past papers. Even I have recorded the class for starting OT cases, 1 revision days for OT case. You can also watch that. You can also, today I sent one message about three ratios questions to you guys, to my registered students, that you can send me one by one. First, send me first question, I'll mark them and I'll send it back to you. Now you will see your mistakes. You will do the second one. You will do the second one with improvement. Then again, you send me, I'll mark it. And then the third question. In this way, you can improve it. Okay. But one thing is for sure, that just for the ratio analysis, each and every, I can see for last 15-20 years, there is a fear in the market for this ratio analysis thing. So it's natural. You can write up commentary up to some extent. Okay, so don't worry about it. And best of luck. Be active in the WhatsApp group. After the class, I'm going to send you these slides as well. The Excel file I'll also send you, and I'll also send you these slides. So you best of luck for your exams. And now as these are last days, don't waste 1 minute even. Daily make a study plan, please. Make a study plan, write, take a paper, write that I'll study 3 days consolidation, 2 days final account, this much day for this thing. Go in this way, go with this flow, okay? Then you can achieve your target, and in this way you can calculate the variance as well, okay? So take care and best of luck for your exams. Stay in touch. Thank you. Allah Hafiz.